A lot of talk recently has been about the concept of economic value added, which is a trademark concept by Stern Stewart and Company. And basically, what they sell is a way to evaluate the divisions within a firm in terms of what they call economic value added, which really means what is added to shareholder value. Now, let me go through the logic of what they suggest that you do in order to do an EVA analysis. And this is just a sketch of what they suggest. Well, suppose that we're looking at a corporation, and this corporation has got some overall weighted average cost of capital that we can obtain, let's say, from the CAPM. And suppose that cost of capital is 12%. And this corporation has got, suppose it's got two different divisions, and there are different business lines. Our one way to do performance evaluation would be to say, well, the hurdle rate for our company is 12%. So you better make, in Division 1, at least a 12% return on your investment in order to enhance shareholder value. In Division 2, you better do the same thing. Now, the problem with this is quite substantial, because it might be that Division 2 is a much riskier business line than Division 1. And we should always measure the value of a project by discounting all of the cash flows into the future and discounting by a rate that reflects the riskiness of the cash flows. So, it could be that Division 2 has a riskiness that suggests the required rate of return should be 15%. And Division 1 is in a less risky business line than the firm on average, and the required rate of return might only be 9%. And I'm assuming that both these divisions are basically the same size, so we get the mixed overall cost of capital for the firm to be 12%, an average of 9 and 15. So really, if we're examining projects, if we're doing project evaluation in these two divisions, and if we have a project that looks very much like Division 2, the same sort of risk, then the discount rate we should be using for that project is 15%. Now you can see, if we have a performance evaluation scheme that's based upon the corporation's overall cost of capital, that we're going to run into trouble. For example, if we use 12% to evaluate the project in that Division 2's proposing, and suppose that project is a project that will return 14%. Using 12%, this project looks good. It's got a positive net present value if you use a discount rate of 12%. The problem is the discount rate is not 12%. It's 15%. And at 15%, it's got a negative net present value. So you need to use a discount rate that's appropriate for the riskiness of the project. In this case, it's 15%. The same thing goes for Division 1. Suppose it is looking at a project that's got a 10% rate of return, and you discount that project with a 12% discount rate, you're going to get a negative net present value. Now the problem here is the discount rate's not 12%. The discount rate for this firm is 9%, this division of the firm. So the true present value is positive. So these two projects that I suggested, if we use the discount rate common across the firm at 12%, then we will accept a negative net present value project for Division 2, and we will reject a positive net present value project for Division 1. That's not what we want to do to enhance shareholder value. Now the other thing is just in how we reward the managers in Division 2 and Division 1. And it's very much linked to the project evaluation. That for Division 2, if they accept this project, they look good. They're delivering 14%. They're only expected to deliver 12%, and the extra 2% is bonus to them. It shouldn't be bonus. We need to evaluate the managers in Division 2 based upon the 15% expected rate of return. If they can't make 15% on their investments, then they're not doing a good job. And it's the same thing for Division 1, that they need to be making 9%. And anything above 9% will enhance shareholder value. Now this is the idea of economic value added, that Stern, Stewart and Company would come in and tell you what the rate of return should be on each division. And if that division makes more than the required rate of return, then there's some economic value added. And you can actually calculate that numerically. For example, if the Division 1 made 10%, but they were only expected to make 9%, and they had $100 million invested, then they've added $1 million potentially to shareholder value. Now this is the idea of economic value added. But if you really think about it, it's nothing different than what we've done already. It's actually just the idea of present value. That we always discount cash flows by the discount rate that's appropriate to those particular cash flows. In this case, in the example I've given, the discount rate that's appropriate is 9% for Division 1 and 15% for Division 2. And if it's the case that Division 1 makes 10% on $100 million, then they've added $1 million. And what is that? It's the net present value. So given their investment and given what was returned, we can discount that back to the present. Or we could look at it at the end of year 1. It doesn't matter. All this is a net present value calculation. The economic value added concept, which is trademarked, is really, in the bottom line, the theory of net present value. Now, I would argue that it's nothing really surprising. I would argue that it's a good thing that in many large corporations they make the mistake of using a common discount rate. But for this course, it is simply called net present value. And we're very careful about how we do it, and we're very careful in constructing the discount rate. But it's really net present value. So the bottom line here is if we're rewarding managers, make sure that we reward them based upon the riskiness of their activities. If it is not the case that we have a reward system like that, then what's going to happen is that it gives the manager an incentive to take a big bet. If they've got some scheme, some compensation scheme where they take a percentage of the upside and the downside is simply being fired or maybe getting another chance, then they will maximize the volatility. And if you think about it, their reward scheme is very much like a call option. They get a piece of the upside, the downside they don't really suffer. If the firm takes a $100 million loss, they're not going to lose $100 million. So basically, the firm has written a call option to the manager. manager's smart. Manager knows basic option pricing theory. Manager will maximize the volatility of that option in order to maximize their wealth. So we have to be smart about performance evaluation. And this is perhaps one reason why financial experts have really only recently and fairly dramatically made huge inroads into the area of human resource management. So the HR people are often trained in finance and trained in option pricing theory. So you can't give a one-sided contract like that. And the critical thing is to compensate on a risk-adjusted basis. This is the idea of net present value. This is the idea of economic value added, and the many variants that many consulting firms go around and suggest that firms should adapt.